Okay, let's dive right into this. Welcome to this explainer, where we take some seriously complex market mechanics and break them down into clear, structured insights that you can actually use. Today, we're unpacking a really fascinating set of mentorship notes from a trading session led by Daniel Tethe. We're going to explore the invisible forces that dictate market movements. Specifically, we're zeroing in on how liquidity magnets move price and the discipline frameworks you absolutely need to navigate them.
It's the ultimate question, isn't it? I mean, you look at your own trading portfolio or you're watching the news and bam, you see these massive sudden surges or violent drops in the market. Most people just assume it's random chaos, right? Or maybe a sudden shift in the news cycle. But beneath the surface, there are very specific unseen market forces dictating exactly where that price is trying to go. And today, we're going to uncover exactly what those forces are.
So here is our roadmap for today. 1. The magnet moving markets. 2. Macro forces and safe havens. 3. Spotting high probability setups. And 4. The financial seatbelt.
Let's start with Section 1, the magnet moving markets, understanding the invisible pull.
Now, what's really interesting about these notes is how Daniel Tethe and Idris Jamalba define this phenomenon. They call them liquidity magnets. You know, liquidity is really just the money present in the market. When you have these massive clusters of unclosed trades just sitting there, waiting to be filled, they act as literal magnets. As price naturally approaches these zones, huge amounts of capital flood in, and it forcefully pulls the price action right toward them. That's what causes those aggressive surges or sudden drops. It's the market seeking liquidity.
To actually see this in action, the notes highlight a really specific example with Bitcoin. Tethe points out a massive liquidity gap sitting right between the 84 and 80.79 range. Because that gap exists, it literally pulls on the price. It causes Bitcoin to consolidate while it builds up the momentum it needs to cross that specific range. In fact, Tethe recommends using a Bitcoin liquidity heat map to actively track exactly where these massive pools of money are sitting.
Moving on to Section 2, macro forces and safe havens. What injects the capital?
40 trillion. That is a staggering number, right? That's the approximate United States national debt discussed in the session. According to Tethe, excessive money printing basically devalues the US dollar, which drags down the United States dollar index. When the dollar loses its value, all that capital has to flow somewhere else to survive. This kind of macroeconomic pressure drives investors straight towards safe haven assets. We're talking things like gold and silver, which historically hold their value really well during economic crises or wars.
But it's not just the dollar driving things. There are several other massive macroeconomic drivers dictating where all this liquidity flows. The notes outline the 4-year Bitcoin halving cycle, as well as the potential regulatory impacts of a Clarity Act being discussed in political circles. Over in the traditional currency space, you've got economic challenges facing the Japanese yen, which heavily impacts pairs like the Great British Pound against the yen. And of course, US oil prices are constantly reacting to inflation and ongoing geopolitical conflicts. These global events, they are the massive engines that inject capital into our liquidity magnets, which then actively move the price on your charts.
So how do you navigate that? Well, Tethe encourages an incremental investment strategy. It's treating crypto a lot like buying fractional shares on platforms like Bybit. The session notes actually detail a mix of holdings: Ripple, SLS, Bitcoin, fractional shares in SpaceX, and even a Trump coin. To better understand the origins of Bitcoin and the whole context behind some of these upcoming regulatory moves, Tethe also strongly recommends checking out the documentary Finding Satoshi Nakamoto.
All right, Section 3, Spotting High Probability Setups, Technical Execution.
Now we get into the mechanics. To find optimal entry points, Tethe applies the Fibonacci tool to divide price action into premium and discount zones. The logic here is super straightforward but absolutely powerful. You look to sell when the price is pulled up into a premium zone by a liquidity magnet, and you look to buy when it drops down into a discount zone. Simple, right?
But it's not just about drawing a few lines on a chart. It's about a very strict, multi-time frame workflow. Tethe teaches a 3-step process. First, you analyze the 4-hour time frame. That's to find the overall market structure and spot any imbalances, basically those gaps between candles where our liquidity magnets live. Second, you drop down to the 1-hour time frame to identify pullbacks. Finally, you actually execute your entry on the 15-minute time frame. Tethe does specifically warn, though, to watch out for daily patterns, like a double top. Even if that 4-hour trend is looking up, a daily double top strongly suggests a high probability of a short-term price drop. It's a liquidity sweep, grabbing money before the upward trend can actually continue.
Which brings us perfectly to Section 4,
The financial seatbelt, mastering risk management.
Tete's notes capture this phase perfectly with a pretty powerful analogy. Trading without a risk management plan is like navigating darkness without a light. Without it, traders face a near-total probability of blowing up their accounts completely. Consistency is just vastly more important than luck.
He expands on this by describing stop-loss orders as your financial seatbelt. If a liquidity sweep suddenly pulls the market hard against your position, that seatbelt is what saves your account from getting totaled. But take-profit orders are equally important. We're human, right? Emotions can't be entirely removed from trading, so setting a firm take-profit locks in your earnings, preventing those greedy emotional decisions from ruining what was otherwise a perfectly winning trade.
So the crucial point here is this strict mathematical rule you have to apply to every single trade. You should never ever risk more than 1% to 2% of your total account capital on a single setup. To put that into perspective, if you're trading with a 1,000 CD account, a 1% risk means you're only putting 10 CDs on the line. A 2% risk is 20 CDs. It just ensures that losing a trade only impacts a tiny, highly controlled portion of your overall balance.
And this discipline directly ties into your risk-to-reward ratio, your potential loss versus your potential profit. A 1-to-1 ratio is considered acceptable, but targeting a 1-to-3 ratio, that's what Tete calls the perfect zone. By waiting for the price to hit those specific Fibonacci discount or premium zones we talked about, you can secure that 1-to-3 ratio. This is the real math of profitability. It allows you to consistently compound your account growth over time, even when individual trades fail.
And let's be honest, you will have trades that fail. Tete explicitly cautions against those unrealistic marketing claims you see online. The guy's promising 90% and 95% win rates. A realistic professional win rate sits between 40% and 55%. And here's the magic. If you maintain that strict 1-to-3 risk-to-reward ratio, winning just half, or honestly even less than half of your trades, still results in a highly profitable, growing account.
Now, to actually get to that professional level, Ted outlines a very structured beginner roadmap. You spend the first couple of weeks just mastering basic mechanics. Then, 3 to 5 weeks studying charts, support, resistance, and news. But the absolute most crucial step is the third one, extensive demo trading. The notes actually share an amazing anecdote about a student who practiced purely on demo accounts for 4 full years while saving their capital through university. That is the level of patience we're talking about here. It's a business, it's not a gamble.
And treating it like a business means strict journaling. Tete teaches using Excel for manual tracking of your entry prices, your stop losses, your returns, or using digital tools like Notion so you can actually attach the chart images to your logs. Logging every single trade, especially the losses, forces you to remain totally objective. It combats FOMO, that fear of missing out. Furthermore, if you ever want to attract outside investors down the line, a verified, meticulously kept trading journal is absolutely your best proof of skill.
For anyone looking for more structured guidance, the notes outline the Denny Forex Academy. It's a 1-year mentorship program priced at 700 CDs, which is roughly $65 US. It's designed specifically to get students to a level where they can pass funded account challenges and trade entirely independently. There's also a separate signal service for 400 CDs a month. And while the notes do mention low recent attendance, the underlying mission remains incredibly clear: grooming disciplined, independent traders who truly understand how to navigate the market safely.
Which brings us to our final thought for today. We've seen how macro forces inject the capital, creating these powerful liquidity magnets that actively pull the price right across your charts. We've seen the precise multi-timeframe strategies used to track them. But knowing where the price is going means absolutely nothing if a sudden sweep wipes out your account. So if the market is always hunting for that next pool of liquidity, ask yourself, is your current risk strategy acting as a financial seatbelt, or are you just navigating in the dark? Thanks for joining us for this explainer, and keep learning.